Let's also welcome on board Raghavan HKN, Senior President Retail Assets at Equitas Holdings, joins us on the show right now. Raghavan, hi, morning. Just going through your profits, or rather quarterly performance, and profits have improved quite sharply, led by healthy NII growth as well, strong fee income. What, according to you, have been the key drivers of these performance? And more importantly, can you actually stay put with this kind of progress in the next few quarters as well?
I think a couple of, definitely if you look at the advances have grown roughly around 44%. And the deposits have also healthy grown around 70%, and now they contribute to 66% of the total borrowing. And coupled with it, you see a sharp decrease in the NPA. The portfolio quality has been extremely good, from 3.13%, now it's at 2.52%, which is definitely a good news, which has also contributed to profitability. And this has been a 40 crores of technical write-off. Even if you add it out, it would have been 2.79%. So there has been a sharp decline in the NPA. So keeping the other cost there, I think these profits were possible. And posting this kind of growth definitely possible, because the segment in which we operate, the penetration is pretty low. Formal and informal and semi-formal clients, a huge opportunity there. And these growths are possible, coupled with if you are able to maintain the portfolio quality. I think we are in for a kind of growth that we are expecting.
Cost of rolling out the bank, has that bulk of adjustment behind Equitas?
Absolutely, it has been behind us. If you look at the kind of growth that we had in deposits also, close to 28% over last quarter, we have grown from 6,800 to 8,000 crores of deposits, and more or less all the branches are in full steam and highly productive. So the cost of budgeting, budgeting of all these expenses have been behind us now.
Broadly, the view in the market is that the end in which you currently are giving money, which is where you're lending, which is the SME sector, people in mid and small towns, that's where I think slowdown will only get acute. Forget about demand, there is going to be a slackness in terms of repayment ability. What is your sense?
I think contrary to the market expectations, market understanding, if you look at the clients that we lend are semi-formal and informal, and they are from local economy. The huge difference between the other SMEs and the clients that we lend, we are all local economy. In a say, it can be viewed as an FMCG product, like for example, selling vegetables, ironing, services. These are all like, it is not very closely connected to the larger economy. So I don't say that it will not impact, but the impact in the segment is going to be lesser compared to let us say an auto ancillary industry, where spare parts, you have so many small companies working in the larger chain. So if you look at these segments that we lend are not of that sort. They're all into service economy. So hence the opportunity is also large, and the slowdown possibilities are low.
The 2 to 3% degrowth in disbursements, if you could just share with us, in which segments perhaps you've seen that in as well?
I think the as per the previous experience also, last quarter, if you look at it, we had elections were announced, plus January has been generally a month which is low, simply because of holidays and Pongal and festivals. And so microfinance, we have seen a dip in terms of disbursement, which is more or less, we want to be cautious in terms of disbursement in this election months. And the small business loans, which is closely a cross-sell to our microfinance clients, has also seen a slowdown. And in coming quarters, definitely it will be back to its normal growth, and some kind of a spillover we expect. The elections are going to get over by say May 15th or May 20th, and after that the growth will start coming to normalcy.
Another improvement has been on the NPAs. While absolute GNPAs have declined 11.6% sequentially, which segments there showed improvements as well, and at what levels can we see further improvement in GNPA by the end of the year from the current levels?
I think the vehicle finance, there has been a substantial reduction in the resolution in terms of NPAs and a lot of better recoveries because our collection vertical has been pretty strong. And compared to industry, we are far better in terms of managing our portfolio quality in vehicle finance. And similarly, in the normal, business loans also, the recovery has been pretty good. And if you look at microfinance, it is well, as per the pre-demon level, whatever the NPAs are there, it was normal. So overall, all these things, they contributed to the, portfolio quality and reduction in the NPA. And we hope to maintain this particular NPA in the coming quarters.
Right. Now, while the deposit book has grown substantially as well, although a strong number, it's slightly lower than peers, Mr. Raghavan. So where do you aim to grow the book to by the end of, let's say, FY 2021?
I see it's currently, if you look at it quarter on quarter, we are growing at about 20-22%, and all the branches are now kind of working with full steam, and we hope to continue these particular growths with the most of the liability branches became much more productive and efficient today. So it's difficult to give a number, but I think we should be able to maintain the current kind of growths.
The CASA ratio, if we take a look at that, at 17.7%, CASA plus retail term deposits is at about 62.6%. What are the internal targets that we're working with here to improve the CASA mix further?
I think the CASA mix anyway, the wish is pretty always used to be around about 30-40% at least in terms of CASA mix. But as you know, we're a new bank, and the relationship with clients takes time, and then I think we're in the right direction, and there has been a healthy growth in terms of savings and current accounts. And very important thing is that as we start increasing our penetration in terms of disbursement of loans to a particular segment, the CASA will also grow as per that particular ratio. So I think in the coming quarters we would only see a healthy mix of CASA to the deposits.
All right, and what led to the decline in NIMs as well? Let's just talk about that. Where do you see them stabilizing in FY20?
I think the NIM is closely related to the products mix that you are. So we are offering a bouquet of products. Our product baskets are very diversified. A couple of years back, if you look at it, it used to be microfinance and vehicle finance. Now you have small business loans, agri loans, and you have MSE. So this product mix is going to become a healthy mix in the coming quarters, which will have definitely a impact on the NIMs. But the thing is that as these better profile clients, the cost of operations will also definitely come down, because the cost of acquiring a 25-50 lakhs clients is far lesser than acquiring a below 5 lakh, below 10 lakhs. So that's what get compensated. So hence yield will become stable. But the thing is fundamentally, if you look at ROA, and ROA has been definitely on an increasing trend from the last 3 quarters. This quarter we are settled out at 1.77. So the mix will the NIM will be a result of the product mix that we are targeting, and hopefully maintaining better quality of portfolio plus the cost of operations. I think we should be able to look at ROA improving and becoming healthy.
Your capital ratios are strong. How long will the current capital last to fund growth, and would there be any need to raise further capital over the next 1 year?
I think we are not leveraged completely as of now. So at least 3 to 4 years, the kind of growth that we are looking at in the near future, we don't see any requirement of increasing the capital.
Much for joining us and sharing the outlook there. Good chatting with you this morning, Raghavan, and on those earnings.